Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Wednesday, April 28th, 2010. Let's begin with the euro-dollar pair, which sank to a new one-year low after rating agencies downgraded Spain, which fanned the flames of sovereign risk spreading across the eurozone periphery nations. S&P lowered its long-term credit rating for Spain to AA from AA+, saying the country would grow more slowly than it had been anticipated. The downgrade followed S&P's slicing on Tuesday of the ratings of both Greece and Portugal, which had sent the euro reeling in yesterday's session. Overnight, the euro had rebounded modestly from its fresh one-year low in yesterday's session overnight, as we had some trickle of positive comments from Eurozone officials on positive progress being made on a bailout plan for Greece. However, after the downgrade to Spain, that rally was sold off and we hit a fresh one-year low at the 1.3113 level, though in later New York trading we did have another counter rally as we moved back above the 132 level, which coincided with the end of the FOMC meeting and their statement. There is talk that the EU and IMF are considering a larger Greek package than originally estimated, and that it will be spread out over 3 years and may reach between 100 and 120 billion euros. Following the downgrade to Spain, we did have Germany's Chancellor Merkel pledge to step up efforts to overcome the Greek fiscal crisis, as the stability of the eurozone was at stake. The market has been selling the euro for the past several weeks after we had reached this 1.37 level following the wake of the announcement of a 45 billion euro bailout package. But as that package has been very slow to be actually distributed or to be approved, we have seen the sell-off as Greek bonds have come under increased pressure. We did see risk appetite rally a little bit in the New York trading, and so that did give us this counter trend rally here. The U.S. Federal Reserve committed today to keeping ultra-low rates in place for an extended period of time, which did help to have a modest rebound in riskier assets and help the euro to counter-rally somewhat in this later New York part of the trading session. U.S. equities and oil prices both rallied following the FOMC announcement. While the euro was pressured rather heavily, the market reaction seemed to be confined mostly to the euro in terms of the Greece problems as well as the problems in Portugal and Spain. And here we're looking at the Australian dollar US dollar pair, and we see that currencies closely tied to global growth did manage to hold on to gains they had seen in the Asian session after this slide that we had seen during the European session. We managed to pare back all the losses, or most of the losses in this pair, and by the end of New York trading, we had hit the 0.9260 level as our intraday high. So that had moved us above our moving averages in the 1 hour time frame. Though all of the 50 period, 100 and 200 period moving averages, simple moving averages, are all clustered rather tightly together in this pair. Still, it's a sign that the eurozone problems are not being carried over to all the different currencies linked to global growth. If we take a look at the US dollar Canadian dollar pair, we see a similar story in that following our very sharp rally in favor of the greenback as our safe haven, in yesterday's session we had the Canadian dollar pairing those gains for the greenback in today's session as we move back below the 1.01. Still, until there is some resolution to at least the Greece problem in the Eurozone, we should see our main currency pairs sticking to the ranges we have seen recently. So in the case of the US dollar Canadian dollar, our high is around the 1.02 level with our low around 0.9950. We also have an upward sloping support trend line. We'll also might see some support around the 1.0050 level, as that is where our 100 period and 200 period moving averages are converging. Oil prices, which have been under pressure to start this week, did rally in today's trading as we came close to $83.40 a barrel level, which was more than a 1% gain on the day. So that helped the Canadian dollar as well as the rise in U.S. equities in later New York trading. Before we take a look at some more market highlights, let's look at the FOMC interest rate decision. As expected, the Fed was a bit more upbeat in its statement about the economic outlook, though the economy still remains too fragile for higher interest rates. The Fed kept its extended period language in regards to ultra-low interest rates, but it did up its assessment of the labor market, as it said it is beginning to improve, which is better than its previous statement that said that the labor market is stabilizing. Job growth is seen as key to Fed's changing policy stance. The statement also said that household spending has picked up recently but remains constrained by high unemployment, modest income growth, lower housing wealth, and tight credit. Voting against the policy action was Thomas M. Honig, who believed that continuing to express the expectations of exceptionally low levels of the federal funds rate for an extended period was no longer warranted because it could lead to a buildup of future imbalances and increased risk to longer-run macroeconomic and financial stability. He has been dissenting with the rest of the FOMC during the entire 2010. As I mentioned before, the statement, while increasing the outlook for the economy, but also keeping the pledge to keep rates very low, helped to boost U.S. stocks as well as some other risk assets. With markets already unsettled because of European sovereign debt worries, the Fed policymakers didn't want to add to market anxieties by starting a countdown to monetary policy tightening. Another signal that today's risk aversion was confined to the euro was a look at the Aussie yen pair, another one of our currencies that is very sensitive to risk sentiment. And following yesterday's steep decline, in which we had declined around 200 pips in today's trading, we rallied to counter all of that decline, and we were testing the 87.30 level in late New York trading. Now again, we do have a bit of strong resistance around this level in the Aussie yen pair, though we did manage to set a new high in Monday's session. We'll see if this 87.60 range will act as resistance going forward. It was a similar story for the dollar yen. We saw the pair hit a low around 92.80 in yesterday's session, which ran up against a level of old resistance that had turned to support, that was broken, and then now is acting as support. So this 92.80 level is quite important, and we did see some buying momentum once we tested that level. Today's high in the pair ran up against our high from Monday, so that is obviously our next level of resistance in this pair. But a move above it will target our other high, our recent high would be around the 94.70 level. Let's take a final look at a pair today, which is the pound dollar, and the pound slid in today's trading, moving below the 1.5150 level for a short time before we rebounded late in New York trading to the 1.52 area. The pound was hit by some negative comments from former Bank of England policymaker Timothy Besley, who said that the UK economy remained in a fragile state and inflation is likely to stay under control this year. The comments pressured sterling as we had a weak first quarter GDP release, which showed that the economy growing at 0.2%, which was half the rate forecast. Now we have seen this pair run up against pretty stiff resistance at 1.55, so if there is a return to risk appetite and we do have some stronger fundamentals from fundamental releases from the UK, we could see the pair retest that area on a bout of risk appetite. Today's support goes back to our levels in early April, as you can see here, which had acted as support following this rally that started on March 25th. So this is the 1.5150 level. If we have continued risk aversion and we have negative fundamentals from the UK, we could see the pound then move below it. That would target all the way down to 1.4850 on the downside. Drawing a Fibonacci retracement of our rally from March 24th to our high around 1.55, we see that today's support also came at the 50% retracement level. So if we were to break below that, our next level would be 1.5070, and then the 78.6% retracement at 1.4950. So it was an interesting day in the markets as we had the euro continue to slide, but as well as the pound, though some of our risk-sensitive currencies performed rather strongly, and the yen gave up its yesterday's gains. The fundamental docket is rather light in the upcoming session. Overnight, the UK will post data on housing prices, Germany posts its unemployment change, and the Eurozone will release data on money supply. Tomorrow in the US, we get only one main release, which is US jobless claims. From Canada, we do have a speech from the Bank of Canada Governor Carney. And that will wrap up today's broadcast. For more news, videos, and analysis, please visit FXTimes.com. I want to thank you for watching and wish you good trading.